Hi guys, as you can understand with the tagline, I'm sharing my short options portfolio with you guys. Of all the videos till now, this video has the most potential to become one of the most important video for next 3 months, at least for all of us. So pay extreme attention to what follows now. I already mentioned on my Telegram group that people create portfolios when they find correction in the market or any stock. They try to do bottom fishing, buying at lows and selling at highs. Something similar can be done when markets are at highs, where we can create a short portfolio that benefits if there is a fall in markets. In fact, I already shared many stocks on Telegram that could be shorted and where I created my positions as well. So here I will share my short portfolio. Of course, it is high risk, high reward portfolio. And the reasons behind the portfolio creation and how I executed this will be shared shortly. But you need to understand two important points before you proceed. First, it's a high risk and high reward portfolio, which means what I am executing here can wipe off 60% of my capital in next 3 months and 20% more by December if things don't play as expected. But yes, it is very high potential and high probability to increase capital by more than 4 times or maybe 6 to 8 times as well. Everyone need to execute only as per their risk appetite and use only portion of capital that they are comfortable to lose in such strategies. Second important point is that I'm not registered with SEBI as of now. What I'm sharing is my individual view. You should definitely check with your advisor or do your own research before executing these trades. You should be responsible for your profits and losses as it is your money. So coming back to my view first, right now there are various reasons because of which I believe that this move can happen between September to November, or a bigger move can come before December that can grow our portfolio immensely. Few of these reasons I will share in this video. But before that, one small analysis that everyone here can do for themselves. If you analyze the recent rallies in top formation, there is something that is common most of the times. Ask yourself, that is this happening right now as well? When markets are about to peak out, few things are common, like lots of IPOs are coming for subscription. Mostly all of them are getting oversubscribed. Mostly all of them are getting listed at premium. We find increased participations of retail investors, as you know, who are finally trapped in this market. Yes, retail investors. Mostly all the companies are coming with good quarter-on-quarter returns. Even though COVID has happened and that would have dampened the performance. For example, take a small drive. You could see for yourself, many businesses are closed. Yes, I totally agree that there has been value migration happening this time. We evolved in this pandemic, but do you really feel that this migration is so smooth that most of the companies are in profits? I mean, seriously? Seriously, you guys feel that so many companies have grown multifold? I doubt it. You should too. Most of us are trying to save more for unpredictable future. We are postponing our demand and not doing much of discretionary spendings. Still, share prices for many stocks are up by 2 to 3 times from their January 2020 highs. Technically, in such rallies, we are far away from our daily moving averages. This you can see for yourself in weekly and monthly charts. As a famous quote goes, in long run, stock prices are slaves to earning. Of course, there could be lead or lag, but ultimately they grow at same pace in long run. Similarly, charts also correct and trade closer to their moving averages until and unless there is massive re-rating of the markets. So, these are few simple analysis that you guys can do on your own. Right now, it's a general consent in the market that there should be some correction. When and by how much? No one really knows. We all know that markets find its own reason every time to correct itself. I know it might sound philosophical, but markets gotta do what markets gotta do. It could be any of the following reasons, like new variant of COVID, like Delta, Gamma, etc., etc. News regarding multiple lockdowns, inflation, Chinese border tensions, who knows, and the recent Taliban Afghan issue, or something new out of the box for us. But why I feel it could happen anytime now or in coming couple of months? To understand this, let's do some basic analysis. Currently, as on 17th September 2021, PE for Nifty 50 is 26.93. Nifty Mid Cap 100 is 28.2. And Nifty Small Cap 100 is 33.73. Now you answer me. When you are getting large cap, mid cap and somewhat small cap at similar valuation, where will you put your bet? Of course, the large caps. Here we have the safety net as well. On the screen, there is a long-term chart for Nifty 50, Nifty Mid Cap 100 and Nifty Small Cap 100. Here you can easily notice that in long run, these indices move in a synchronized manner. But whenever there is a big divergence, there is a sharp correction. Typically, it is headed by Nifty Mid Cap and Nifty Small Cap indices. If you see the last part of the chart, just take a look. You can easily notice the change in momentum, where Nifty is still moving up, but the other two are moving down. Now let's check out our global counterparts, where various global markets are giving us signals. For example, Brazil from roughly past 2 months is continuously trading below its 50 DMA, that is daily moving average. And currently in September, it's trading even below its 200 DMA, even though when US Dow and Nasdaq 100 were hitting lifetime highs. Let us see which other important indices have come closer to its 200 DMA. Recently, for example, Hang Seng on 19th July went below 200 DMA, and currently it's below 11% from its 200 DMA. Nikkei fell below 200 DMA on 12th of August and bounced back and is currently 6.8% above its 200 DMA. Small cap index of US, that is Russell 2000, breached 200 DMA on 19th of August and bounced back and currently trading at 1.6% away from 200 DMA. KOSPI, that is KS11, as of last closing is less than 1% away from its 200 DMA and could break it any day soon. Taiwan weighted index is just 4.9% away from 200 DMA and very close to 50 DMA. China A50 futures is 12% below 200 DMA, and same follows for many other global markets as well. US Dow, Nasdaq and European indices like FTSE, DAX or CAC 40 are trading either below 50 DMA or very close to it. But Nifty 50 is 6.41% above its 50 DMA. So as mentioned few minutes back, we are close to the blow off top or already done. Currently commodities are also under some pressure. It's visible in crude oil prices, which is below its 50 DMA. We can see for past few sessions, volumes are also down in Nifty as well. With crypto's prices again moving up, we can also guess that big investors are considering gold to be safe haven again. So now let's start in the in-depth analysis of Nifty before sharing the short portfolio. Just to analyze thoroughly, I have taken weekly candles to target longer period and do in-depth analysis. Here, the yellow line represents 9 daily moving averages. Blue represents 50 DMA and green 200 DMA. As mentioned earlier, markets tend to trade closer to its 50 DMA and the bigger correction bring it close to 200 DMA. This you can easily notice on the charts. But let's add two more components to analyze this data in a much better way. First is the percentage change from DMA to current price. And second is RSI, which is Relative Strength Index. Let's start with housing bubble. On the charts, you can notice that during 2007 and 8 period on 13th of August 2007, Nifty was trading close to its 50 DMA of 3,991. At that time, RSI was at 46 levels. Later, market peaked out on 7th of January 2008 when it hit a new high of 6,357. At that time, RSI was 71 and Nifty was 37% away from its 50 DMA of 4,693. But what happened next shall be part of your analysis. And in next 2 weeks, market fell towards 50 DMA. It fell from 6,357 levels to 4,463 levels. It was roughly 30% fall. And since it was a bubble, later it also breached 200 DMA and fell towards 2,252. At that point of time, RSI was 27. Combined with a fall of roughly 65% fall from the top, it roughly took 10 months for the bottom formation. Next time frame is 3rd of February 2014. At that time, the Nifty level was 5,942, which was its 50 DMA, and RSI was at 50. From there till 2nd of March 2015, Nifty hit a new high of 9,119. At that point of time, RSI was 70 and 50 DMA was at 7,902 levels, which is like 15% away. What happened in next 8 weeks is your analysis. And yes, you are right. It came to 50 DMA. It was a fall from 9,119 levels to 8,170 levels, which was 10% fall. And finally, it touched 200 DMA of 6,825 on 29th of February 2016, which was again 25% fall. And it took roughly 1 year for this declining formation to occur. The next time frame is 2nd January 2017, when Nifty was trading at its 50 DMA of 8,127 and the RSI was at 49. From 2nd January 2017 till 29th of June 2018, Nifty rose to 11,171 levels. At that point of time, the RSI was at 77 and 50 DMA was at 9,875 levels. So what happened in next 7 weeks is that it came to its 50 DMA. It was a fall from 11,171 levels to 9,951. And it was a very sharp fall by 11% in just 8 weeks. Similar things happened on 19th of March 2018 to 27th of August 2018 and also happened multiple times in past. And you can always check it out for yourself during different time frames. Now comes 2020, post-COVID. So this current rally started from around 21st of September 2020, when Nifty was at its 50 DMA of 10,944 levels, and the RSI was at 54. From there till Friday, 17th of September 2021, on weekly chart, Nifty has risen towards 17,792.95 levels as of now. This is roughly 17.5% away from its 50 daily moving average, which is at 14,710 level, and roughly 33.55% away from its 200 DMA, which is at 11,893 level right now on weekly candles. In daily time frame, 50 DMA is at 16,456 and 200 DMA is at 15,149 levels. Even if Nifty comes to its daily DMAs on daily time frame, we are done with our targets for this portfolio. So with a very high probability, in next few weeks we will likely test 50 days DMA. And if we are in a bubble, we may see 200 DMA in coming few months. But here I would like to quote with high probability that breaching 200 DMA seems like a tough nut to crack open. To understand this, let's talk about some global emerging markets. Right now we have seen rotation happening in many countries. So many emerging markets have tested their 200 DMA. And right now you can easily see the pattern formation. So yes, we could be the next or next to next, but the correction is inevitable. That is sure to happen. Here one can draw a small analysis from the past bubbles. In bubbles, all the markets went up roughly at the same time and fall around the same time. But this time, it's a liquidity shift that is searching for better returns. Also this time, apart from previously available diversification assets, the big guys are also investing in cryptos. Now let's begin with the most important and much awaited part for this video, our short portfolio. As we all know that if the markets have to correct, stocks have to correct as well. With small analysis, I tried to find out those scripts where I could get better returns with good safety net. Before sharing the portfolio, I would like to tell you the two approaches in which such short portfolios can be created. I will be sharing the Excels for both, and finally you can choose as per your capital and risk appetite. Approach 1 is simple: buying ITM puts with 1 or 2 expiries away. For example, one can buy for October. If by end of September the down move does not come, shift it to November, but always keep this ITM. This will reduce the impact of time decay as well. In this case, time won't let you lose much, even if initially markets move in opposite direction. Approach 2 is what I'm implementing for myself. In this, I will create a bear call spread strategy in current series and buy OTM puts in FAR series. As we all know, buying OTM options is kind of gamble, but current situation is such that these OTM options can give us multiple time returns in a very short span of time. Currently on the screen you have the Excel where I'm sharing the scripts where I have created portfolio for myself. It has rates as of 17th of September 2021. Average rates may vary from personal portfolio, as I was in construction phase for last 2 weeks. But for you guys, it will be more relevant and beneficial that you learn from the last closing prices and other technical details as on 17th of September 21. We will use these rates for our follow-up on these trades. You can see in the Excel, these are the scripts where I have created my short position. I have included Nifty in the portfolio, but not Bank Nifty. So here are the scripts that I have shortlisted for my short positions. Here the explanation is simple. RSI is on higher side. These scripts are away from their 50 DMA and 200 DMA. These scripts are close to 52 weeks high. Technically, many of them are close to their resistance levels. In last 2 columns, I have mentioned my initial targets. Of course, as we all know, index fall is supported by few stocks that don't fall to the same extent with markets. And they provide support to the markets when any stock starts falling, like even 15 to 20% fall can come in a few days. So here final target depends on market conditions. So that will be bonus to all of us. I will try to update as and when I am changing this portfolio or booking profits for myself, either here on YouTube or through my Telegram channel. Telegram link is below. Of course, here few stocks are high beta, and that is why the premiums are higher, but returns from such stocks could be much higher. I have kept Adani Entertainment and Mindtree in my portfolio. It's a high risk reward stock and also needs high funds. So only high risk traders shall enter in this stock. Now you can understand that I have a better cushioning. Markets are expected to fall and I am shorting these stocks that are expected to fall. Now, due to time constraint, I have to take a pause here. In part 2 of this video, we will discuss on the 2 approaches that how you can benefit from this portfolio along with a bonus at the end of part 2. See you guys super soon and happy learning as always.